Hi, I'm Daphne Botha. I'm a portfolio manager at Futuregrowth Asset Managers. Today, I'll be talking to you about how we are navigating the fixed income markets in a post-COVID environment. Futuregrowth is the fixed income boutique within the Old Mutual Investment Group. We have 189 billion in assets under management. We also run the 4 fixed income unit trust funds for Old Mutual Wealth. So, over the last 15 years, this slide is depicting the risk and returns within the domestic asset classes in South Africa. So the bottom line shows inflation, as represented by CPI, and the top line shows the all-share index. So the more risk you take, the more return you get, but you can see that all-share index is quite volatile compared to the indices below that, which is the all bond index, the inflation-linked index, and the cash index. The interesting thing about this chart is over the long term, all these indices outperform inflation, and that's a really good thing for an investor. Looking at the same chart, but over a much more shorter period, you can see the reverse is true here. In fact, over this period, only cash convincingly outperformed inflation over the short term. You can see the effects of the COVID-19 pandemic in March 2020, where you can see equities in particular having a significant drawdown. The other interesting thing about this chart is, in fact, that most of these indices have recovered to near pre-COVID levels. What's the message in that? If we focus specifically on the bond market, you can see the red line towards the middle of the chart. That line shows you the yield curve a year ago. You can see it's relatively flat compared to current. That yield curve was still quite steep, with the difference in yields between the short end and the long end bonds being over 300 basis points. In March 2020, during the COVID pandemic, when markets sold off significantly over a couple of days, a week, you saw the R186 sell off to levels close to 12%. You saw the R2048 sell off to levels close to 14%. The markets have since retraced from those levels, but the volatility during that time was quite extreme. Since then, you can see the level of the yield curve now in July 2020. The short end of the yield curve has come down significantly. So in the R208 area, you can see over 150 basis points of yield compression. That was principally led by Reserve Bank action. So in March, the Reserve Bank cut repo rate by 100 basis points. They did so again in April 2020, and then they cut another 50 basis points in May 2020. So that's 250 basis points of repo rate cuts over a very short period of time. And the market is reflecting that movement. In the long end, we've seen yields rise. Close to 100 basis points of yields higher in the R2048. So there, what the market is saying, we don't like this COVID-19 and the impact it has on the bond market. We're expecting more bond issuance. So excess supply means higher yields. So let's bring that back to the funds. The 4 funds on here are the 4 fixed income funds we manage on behalf of Old Mutual Wealth. On the x-axis, it shows interest rate risk. And you can see the Old Mutual Bond Fund has very high interest rate risk. Its interest rate risk is sitting at around 6.3%, whereas the Old Mutual Income Fund is sitting at 1.5%. On the y-axis, we're showing returns. So there, we're showing the 3-year returns up to 30 June 2020. This chart tells us that over this particular period, your Old Mutual Income Fund has the best risk-return blend of these 4 portfolios. So in that portfolio, we've got the balance right between risk and return. So just focusing on that specific fund in a little bit more detail, the first thing that strikes you about this chart is the level of return. Between 9 and 10% of performance over, over 20 years. The other thing that strikes you is the consistent outperformance relative to its benchmark. So the benchmark here is 20% all bond index and 80% STEFI composite index. It's approximately 1.5%. Over the last year, our performance has been better, but over the long term, this fund has produced 1.5% above its benchmark. This particular portfolio has a constraint that it's not allowed to have 2 consecutive months of negative returns, which is a risk mitigant for investors. So, all the slides I've shown you now, those are the past. It's historic returns. It doesn't give you any guarantee as to what's going to happen in the future. So now we want to look at the market and how we're positioning our funds going forward to make sure that we maintain that great return on the Old Mutual Income Fund. So the single biggest risk facing domestic bond investors is global domestic growth. So this chart represents South Africa's GDP from 1994 to present. You can see for the last decade, since the global financial crisis, we have had declining growth. In the last half of last year, we had 2 negative quarters of growth, and that means we were in a technical recession. We went into the crisis in March in a technical recession. The first quarter GDP numbers were released recently, and that came out at -2%. So we've had a 3rd consecutive quarter of negative growth. The forecast for this year, if you look at the black arrow, the forecast for this year is showing a -7% growth reduction. That is a terrible number for this country. It is unprecedented. We haven't seen that in the recent past. Why is that a problem for bonds? So the reason is, as growth drops, the implications are government revenue will drop. Companies are falling, people are getting unemployed, and people are not spending as much as they used to. And the impact is on VAT. No, less spending means less VAT for government. Companies failing means less corporate income taxes, and people losing their jobs means less personal income taxes. So in order to make sure government balances the books, they're going to have to come to the bond market and issue more bonds, or go to the money market and issue more treasury bills. And that is the negative component for fixed income yields. So this is a busy slide. If you look at the bottom of the slide, budget 2020, that shows you at the Feb budget this year in 2020, government forecasted between 65 and 72% of debt to GDP for the medium term. That already was a high number, and markets reacted negatively to that. Post-COVID, and you remember the 500 billion bailout package and other growth-enhancing strategies, we expect that number to rise. The forecast for this year is between 80 and 100% of debt to GDP. The thing we need to concern ourselves with is not that number in itself, but how it impacts bond yields. If you look at the zero line, at the 77% debt to GDP number, we forecast a 10% 10-year yield. Currently, 10-year yields are at 9.5%, so we expect 10-year yields to rise. So just to put that into a little bit more context, this is a technical slide that shows us our forecast for the 10-year yield in particular. So the red line shows you the SA long-term, the actual SA long-term real yield, what that yield is actually done over history. And the teal line shows our forecast. And our forecast takes into account inflation, takes into debt levels, it takes into the US 10-year rates as well as the SA repo rate. And you can see that the forecast for the teal line in 2021 and 2022 is going straight up. So that is not positive news for bond yields. We're saying the risk of bond yields going higher is incrementally more than bond yields staying the same or going lower. So government has to issue all these bonds. We expect yields to rise. And we've also lost a major buyer of SA bonds. So this chart shows foreign ownership of SA government bonds. So you can see this, it was increasing steadily since 2011. In May 2018, it reached a peak of 43%. Since then, we've had a gradual decline and a significant decline over the past few months, and that was led predominantly by the expectation that Moody's will downgrade the South African sovereign bond rating, and the result of that is that the South African bonds would be excluded from the World Government Bond Index, or the WGBI as everyone refers to it. So that event has now happened, and that's why we're seeing the foreign ownership levels decline to below 31% at the most recent data point. So that's a very negative story. We worry about government debt, we worry about who's going to buy them if domestic investors don't step up to the plate. What's the good news? The one big positive story that we have is inflation. Inflation historically is the single biggest driver of domestic bond yields. That has changed over the last 5 years at least, driven by fiscal risks. So you can see inflation has dipped materially over the last few months. The latest print on inflation was 2%, and the forecast for this year is sitting at 3%. In addition to that, to it being so low, it's also structurally gone lower. I mean, if you look at the period from 2010 to 2017, inflation in that period was around 6%. We're seeing inflation now hovering around 4.5%. So we've structurally gone lower in terms of inflation, which should support bond yields in the long term, assuming that situation stays the same. The other big positive factor affecting bond yields is the current account balance. So there, you can see that the most recent move has been a significant move towards the zero line. The current account is still negative, but we're moving towards a neutral or a positive current account balance. And that's largely because of the environment. Due to COVID, there's less spending, less imports. In addition, we've had a oil price collapse. That means our imports of oil is costing us far less than it did a year ago. The other positive is the absolute level of yields. So while the story is negative, we must not forget what is already in the price. If you look at the long-term rate, the long-term 10-year rate, you can see it's way above its 10-year average. And that is really good. That's telling you the market's pricing in a lot of risk. So do you want to now add on more risk onto that and price yourself out of this market? So don't get too negative. A lot of risk is priced in. If you look at the top chart, it shows the prime rate relative to the repo rate. There, you can see the levels are positive as well. So even though everybody's not constructive on money market, there is still a bit of a positive carry there. How does that translate into the bond market? So this chart shows our expected returns in the bond market over the next 12 months, assuming yields stay unchanged. So at the short end, we've got the money market yields, and it's quite anchored because we've had 275 basis points of repo rate cuts for this year to date, and there's a risk of more repo rate cuts. So there's a chance that this front end could shift even lower. If you look at the rest of the bond yield curve, starting at the 186, it's relatively flat. What does that tell you? It tells you you can take a position in the bond market without taking on additional risk by focusing on the middle area. Your R186, your R2030, and your R213, or your 2032. Your 10 to 15-year bonds. You can use those bonds as a proxy for the entire market without taking significant interest rate risk. And that's where we've positioned the income fund. The R2030 and the R186 are two specific bonds we've bought for that particular portfolio, and we've avoided all the long-dated bonds. And by doing that, we've avoided significant risks. And this shows you our positioning in that particular fund. The gray bar shows our interest rate risk. The red bars show the term to maturity. So you can see we've got long-term instruments in the 1 to 3 year and 3 to 7 year, but our interest rate risk, the significant component that produces returns, is actually in your 0 to 3 month area. We've got a lot of term floating rate notes in the credit market, and we've got a bit of exposure in R186 and 2030. We don't have a lot of cash instruments. You can see our 3 to 6 months, 6 to 9 months, 9 to 12 months is low. And that's because cash is relatively low. It's better to invest in the credits and short-dated bonds to get the balance between interest rate risk and base accrual correct. On this slide, what we show is not only the income fund, but all the other fixed income funds we manage for Old Mutual Wealth. The red bar shows inflation, and this is the absolute returns of the funds. It's not relative to a benchmark or a peer. You can see over most of the periods, the income fund in the dark teal color shows quite decent, consistent returns. Over 2 periods, the 10-year and 20-year, you've seen that bond fund outperform, and it's got higher risk. So generally, your higher risk funds will perform better over longer periods, your lower risk funds over shorter periods. But you can see the consistency of the income fund over all periods is quite attractive. So I've shown you a few views of risk and return. I've shown you what happened in the past. I've shown you what we think might happen in the future. I think the key takeaway for us is there's a lot of risk priced into the market. You've got to get that balance between risk and return absolutely right. You've got to get your investment horizon absolutely right. So if you're a long-term investor, going into money market might not be the thing for you. If you are a risk taker, you might want to consider something like the bond fund. But you've got to understand the risks that you're taking on, and you've got to understand the potential rewards that you can get in terms of return from that. Thank you so much for listening to me. I hope you've enjoyed the presentation.